Hi, everyone. Thanks so much for joining us today for our 39th annual Cornell Real Estate Conference, taking place via a series of 4 virtual events, this being the second. I'm Alan Rifkin, one of the 3 co-chairs of the conference, along with my fabulous co-chairs, Jen Davis and Lonnie Young, who you'll probably meet during our 4th and final event. For most of the past 4 decades, we've organized this conference to bring together Cornell students, alumni, faculty, and many of our non-Cornell friends to discuss the most pressing issues facing our industry and the country. This year's no different in that we have an all-star lineup of speakers to address timely and important topics. But unfortunately, again, due to COVID, we're hosting this remotely. For many of you who joined last week or watched the replay afterwards, I hope you agree that CNBC's Dominic Chu's engaging interview with Debbie Cafaro, the CEO of S&P 500 company Ventas, was a great start. And if you haven't seen it, you should find some time to watch it through the link available on the correct website. I'm sure today's event will be amazing and also insightful, since we have Dom's CNBC colleague Diana Olick moderating a discussion with 3 leading CEOs in the residential housing sector, and I know they're going to have some really interesting things to share with you. As a reminder, there will be 2 more events following today's, and I hope you'll join us for those. You can find details on the correct website link, which is posted in the chat box below. A couple of quick housekeeping points before we get started. First, I want to thank Cornellian and Planning Committee member Bruce Backen for generously sponsoring today's event, and also our incredible group of sponsors whose names appear on the screen for their very generous support of this whole conference. Their donations have allowed CREC, the Cornell Real Estate Council, an alumni-led nonprofit with more than 2,000 members, to host this conference without any registration fees to you. The funds will also help CREC, one of the largest university-based real estate alumni networks in the world, to serve alumni and, importantly, nurture interest and talent among students with a focus on helping diversity, equity, and interest in the real estate industry. And with we know we have a lot of work to do in the industry, and we know DEI has a real impact. And in a few moments, I'll introduce Dave Rupert, who will provide a few more details about CREC and our mission. I also want to acknowledge some significant support and collaboration of other parts of Cornell that have helped to plan and execute this year's real estate conference. The Cornell Center of Real Estate and Finance, the S.C. Johnson School of Business, the School of Hotel Administration, the College of Architecture, Art, and Planning, and the Baker Program in Real Estate, which is our 2-year real estate program. And most importantly, I want to thank the Planning Committee members listed on the screen, who, in the collaborative Cornell spirit, have worked tirelessly over many months to organize this conference, with a well-deserved shout-out, again, to Amanda Redless, who is the Associate Director of CREC, and the glue that held us all together for the past 6 months. For this event, everyone except speakers will be in a listen-only mode throughout the whole event. Depending on timing of discussion, there may be, and hopefully, an opportunity for Diana to select a few questions to address to our panel, so please pose them in the live chat room feature at the bottom of your screen, not in the Q&A section, but the chat room. As a reminder, this webinar is being recorded, and the speakers are offering their insights openly to you, so we ask that the attendees, including any press who may be participating, not to use any dialogue or content contained throughout for attribution in any manner without express permission. With that, let me introduce my friend Dave Rupert. Dave is the president of Griffin Capital, an alternative asset management company, a founding member of the Baker Program in Real Estate at Cornell, and a board member and the president of the Cornell Real Estate Council. Welcome, Dave.
Thanks, Alan. And again, I want to add my welcome to yours for all of our many hundreds of, almost probably over 1,000 by now, attendees for today's conference. I'm joining you without my typical teleprompter or media setup, because I'm in a hotel in probably one of the hottest commercial real estate markets in the country in Nashville, Tennessee. And I'm proud to represent the voices of the Cornell Real Estate Council and just give you a few more facts about that group than Doug just mentioned. So we're a volunteer-led 501c3, so nonprofit, and we represent the interests of what we call the voices of real estate at Cornell. And that's both undergraduate and graduate students, alumni, and what we call FOC, Friends of Cornell. So both commercial and residential real estate. And we've been doing this for the better part of 3.5 decades. And we have three goals, furthering the academic, educational, and aspirational goals of our more than 2,100 members. And as Doug mentioned, and most of you have registered on the cornellrec.org website, we have a number of initiatives that are really addressing what we believe is the lack of inclusiveness and representation of a broad, diverse group of people in the commercial and residential real estate industries. And you can see those under our initiatives tabs on our website. And just speaking specifically just under DEI, that's just one of 4 initiatives we have. But we've worked in the last 24 months with historically Black colleges and universities to sponsor a case competition, which had incredible support and involvement. We worked with Cornell University's architecture school to attract and financially support high school students who wouldn't otherwise be exposed to the world of architecture and the built environment. And we have, just looking down under our initiatives, we have our Correct Women, we have our Career Advisory Program, we have our regional chapters, and we have a distinguished speaker series that takes place between our annual Cornell Real Estate Conference. So we're doing a lot, and it is made possible through the generous support of our sponsors. So again, reiterating Doug's support for all of them. And our keynote event is this conference. And one of the things that we like to do is distinguishing this conference from others is providing great takeaway value and really inspiring moderators. And that's really a great segue for me to introduce Diana. So, you know, we're not working with moderators who are trying to think of what questions 1 through 5 are. They're starting, you know, at 6 and going to 10 and beyond. And Diana really fits that bill. And again, I apologize without my teleprompter. I just want to make sure I don't leave out any of the superlatives that describe Diana. But Emmy award-winning journalist. She's CNBC's real estate correspondent. So again, both commercial and residential across all of CNBC's platforms. She's won a Gracie for her blog. She's seen, as many of us have seen her on the Today Show, Nightly News, and as a guest on NPR. She was among the early voices in understanding and explaining the subprime mortgage, and then given her the longevity of her career, various housing boom and bust cycles. So I extend a warm welcome to Diana, and I will turn it over to her to introduce her panel and moderate the discussion. Diana, over to you.
Thank you so much, David. It's an honor to be here and an honor to be among such real estate colleagues who I'd like to introduce to you. We have just the top in the business, Gary Berman, President and CEO of Tricon Residential, Doug Yearley, who also happens to be class of 82, Cornell, Chairman and CEO of Toll Brothers, luxury home builder, and Drew Flahive, who is president of Amherst Residential. And I don't want to waste any time at all, but just get right to it because we have so much to talk about. And I know we're all excited to talk about everything. So we're going to talk about what I believe is one of the hottest sectors in the real estate market right now, and that is the single family rental sector. There have always been single family rental homes, mom and pop, small investors, but after the subprime mortgage crisis, you saw a lot of institutional investors get into this market. You saw a lot of private capital coming in, and 15 years later, we still see the money pouring into single family rentals. And that's where Gary and Drew really, I want to get right to you. Gary, you've talked about how your company, while invested in single family rentals, differs from others. Give us an idea of what you do and why your company is different than some of the other investors in single family rentals.
Well, we're public, Diana. So I think if you look at the public context, if you compare us to Invitation Homes and AMH, the other two big public players, the big difference is we focus more on the middle market. We call that the low turnover middle market. And also we have a little bit more focus on the Sun Belt relative to our peers. But the big thing I would say is on the middle market, and we very strategically decide to buy a smaller home. It might be in the exact same neighborhood as our peers with similar schools, but we're strategically trying to buy a smaller home, let's say about 1,600 square feet versus our peers that might be at 2,000 square feet, still a 3-bedroom, 2-bath. But the idea behind that is to drive affordability. So a family can live in that same neighborhood, send their kids to the same schools, but save money on rent. And we think over time that leads to a lower turnover model. And we think the trick in single family rental at the end of the day is to drive a low turnover model. So that I would say is the big difference.
And Drew, are you surprised that this many years after we saw the big run from institutional investors on single family rentals that we're actually seeing more than ever now?
No, not at all. And I actually think that this is really just beginning. If you look at the portfolios of the largest commercial real estate investors, they're generally underinvested in single family rentals as an asset class. I've yet to find anyone that's overweight. So of our current investors that are investing with us, they're looking to all add more. And so I think that this trend is just now continuing and will continue for the next several years, just in terms of the formation of capital around this. You know, Gary's platform, our platform, and others have really shown that an institutional investor can own this asset class, right? Prior to the financial crisis, there weren't the set of services around for institutional capital to invest how they would normally invest in multifamily, office, retail, or industrial, and we've all set that up for them.
Doug, how are these guys making it harder for you when it comes to getting land that you want to build on and actually sell houses?
Yeah, it's a hot part of the business. We're certainly feeling a bit of it. Our average price point is up around $900,000. So most of our land buys and locations are not competing with either the SFR or it's more the build to rent, the build for rent crowd, where they're building communities of homes that will be rented, as opposed to disparate single family homes in various different neighborhoods. But we have invested in the business through an operator. We have an apartment division that is building primarily urban and suburban communities, but through that Toll Brothers Apartment Living Group, we are also investing in the purpose-built single-family rental communities. But there's so much capital chasing the sector that they are now competing with the big home builders for land. And because they underwrite to a different return, because they want to build the houses quickly, rent them up, and then sell at stabilization, and the cap rates are so low on the outsale of all of those homes once stabilized, that they can back into a land value that is significantly more than what the for sale home builders will pay. And so there's absolutely competition, particularly at the lower price point. Again, not directly with us, but we're certainly feeling it in the group, in the industry.
Well, when we talk about, you've got apartment communities, and we've seen demand for that as well, and I'll get to the high rents out there, but I'm wondering, a lot of the folks out there are the students out there who might be listening to this, and they're thinking, okay, I'm going to graduate from college and I'm going to an apartment. Why do we need so many single family rental homes? We have, I believe at last count, 1 million more than we did just 15 years ago. Gary, Drew, either one of you want to comment on that?
Yeah, well, I mean, college students, might not need to move into a single family rental home right away. Maybe they're going to live in an apartment. But really what we're trying to do is we're trying to think about housing as a ladder, right? And ultimately what happens as students graduate in life and form families and have children, they then need more space. And we think a single family rental is really the kind of the perfect starter home. You don't necessarily need to buy a home. And I would also say a lot of people that, that idea of having to buy a home or accumulate possessions or even own a car, a lot of millennials that we talk to don't have those aspirations. So the idea of being able to rent a home and live in a maintenance-free lifestyle, which is very, akin to the sharing economy we're living in now, is quite attractive, right? And it really gives everyone more options and more choices. So it's really single-family rental. We think is something that's more down the road. It's really benefiting the millennials right now as they come into their primary years of household formation. And I would say, back to Doug's comment, I think this industry actually did help the home building industry tremendously. Maybe today is providing a little bit more competition on for sale. But when we were coming out of the downturn and the subprime crisis, we actually put a floor, on the industry and helped buy homes and help lift prices, which helped everyone get above water. So I think the single family rental industry really is very valuable in that sense, because it helps provide a floor in what otherwise could be a very cyclical business, and obviously provides consumers with more choice.
Well, I agree with you on that you put a floor on prices back during the crisis, but a lot of folks are now arguing that you're actually inflating prices right now, because there are so many investors in there with cash buying up the precious few homes that there are available for sale, especially on the lower end of the market, or they're building them but only using them for rent, not to sell. And that's pushing that first time buyer out, making it too expensive to get into that. Drew, what do you think of that argument? Just what I hear, not what I'm saying.
Yeah, well, I would say that the investment, buying single family houses as an investment, it ebbs and flows over time given the economic cycles, but overall it's not outsized from where we've historically been. The mix shift is a little different in terms of more institutional capital there, but it's not outsized. And I think the other thing, which is a really interesting topic to debate, is when we buy a home or Gary buys a home, he and I aren't moving into that. Another family of four is moving into that home. So it's not like that home is taken down and taken off the marketplace. Another family of four moves into that home. And generally speaking, that family can't get a mortgage. And so, there's this interesting debate on, do you have to have a mortgage or be mortgage eligible to live in that neighborhood, even though otherwise you can afford to live in that neighborhood? So there's a lot of push-pulls on that. Ultimately, we put in $20,000 to $40,000 of CapEx into these homes. So a lot of the homes that we at Amherst are buying are homes that the other family of four isn't necessarily going to look to buy because they're not turnkey ready. And so we go in, do a heavy CapEx, and really lift the ugly house on the street up to where it needs to be move-in ready. And then a different family of four gets to move in, and instead of it being a mortgage payment, it's a lease payment. So I think there's like you said in your opening remarks, there's always been room for single family rentals. It's a big part of all of America, housing over the last century. So, it's really, institutionally, this is a lot of parallels to multifamily over the last 20 to 30 years, which is institutionalizing it, getting the product up to much higher standard than most single family rentals are. And also the servicing aspect is very different than the mom and pop owner.
Yeah, and it's interesting that in the build for rent sector, a lot of those developers are calling it horizontal multifamily. That is, whereas you usually have a tall apartment building that you manage from floor to ceiling, you now have lots of homes, but all next to each other, and you just manage them horizontally. What is your advice then for those who might want to get into, for a student, for a graduate, for an alum, for somebody who's out there and says, you know what, I'm seeing these great opportunities. I don't want to flip the house necessarily. I want to get in as a single investor, but there are all these big guys out there with all this cash like you. What kind of advice do you give to young investors who might want to be a landlord?
I guess I'll take that. I think single family rental, number one, is the most exciting business in real estate, bar none. I think there's credible opportunity for, students or graduates to get into this business. And I think build for rent as an extension, whether it's horizontal apartments or more conventional build for rent communities of detached homes, is an incredibly exciting new business that is in the early days, as Drew talked about. And I think we're in terms of institutionalization, still very early days of probably where multifamily was back in the mid 90s. And you see the run that, traditional multifamilies had over a couple of decades. I think that's where we are with single family rental. There's tremendous opportunity, and the industry is going to continue to grow and professionalize. And there's always opportunity for people to aggregate, to buy homes or to develop one community there, and then sell it. And as the industry gets institutionalized, there's obviously a deeper market to buy that and to monetize your investment. So I think this is if you're focused on real estate, this is a great place to be for the future.
And I'd also say one other thing, just a little plug. We have over 250 job openings. So if you really have that itch, come, give us a call, because there's a lot of opportunities, whether it's more on the finance side, the operations side, and everything in between too. So, I think this industry's changed a lot over the last 10 to 15 years. It's going to continue to develop, and to be a part of that's really, really exciting as someone coming out of college and looking for what's next in their life.
And that actually transitions well into the next thing I wanted to talk about, which is for single family investors like yourself, or for home builders like Doug. We talk a lot about this day in and day out on CNBC, supply chain issues. That is, whether it's from COVID or before, shortages of workers. You have a lot of job openings, shortages for land, labor, material, all of the supplies and the labor that go into managing a home, rehabbing a home when you buy it and you want to put it up for rent, and building a home. Doug, tell us how that's affecting your business specifically.
It's unprecedented. I've been doing this 31 years. I've never seen the struggles we're now having to get houses completed and delivered. We used to take garage doors and windows and appliances and heaters and air conditioning units for granted, and you can't anymore. It is extending construction cycles several weeks. It's frustrating clients when we have to move them in with temporary dishwashers or refrigerators that aren't the exact model they picked. Yes, it's COVID driven. The port cities in China would have one COVID outbreak and they would shut down the port. the chip manufacturers in Taiwan or anywhere else would be shut down when there was a couple of COVID cases. The shipping lanes the stories are obviously front page news. I was in Southern Cal last week visiting our division and saw firsthand what's going on at the Long Beach port. I was in a helicopter. I counted 77 freighters between Long Beach and Catalina Island. You could jump from one to the next and probably make your way from California to Catalina. There's no room on the port. The trucks aren't there to take the containers to bring in the next ship, and we have serious issues that are going to take a few more quarters to work out. We will get there. It is slowly improving. I've been talking to the CEOs of all of our major suppliers, and they're just beginning to tell me that they're hiring more people. They're seeing a little bit of brighter skies, but it's going to take some time. The labor issue is longer term. That is not, it's acute now because of COVID, but we had the labor issues earlier. They will continue. There's a lot of immigrants that build houses. Immigration policy is critically important to our industry. U.S. kids today don't want to be plumbers and electricians and framers and carpenters. And trade schools have disappeared, unfortunately. And we've got to bring that back because it's a great living for a lot of people. And there's a shortage long term that we have to address once we get outside the supply issues that are more short term.
And Gary, does that in any way slow the number of homes that you might want to buy because you might not be able to get them rehabbed or set for rent fast enough?
We've been ramping up our acquisitions quarter over quarter. It's got no impact on our ability to buy acquisitions. It does slow the time it takes to renovate a home a little bit. It's taking us a little bit longer. Everything Doug's talking about is real. There are challenges, but I would say in our business, they're not insurmountable. And think about it more like this. We might buy a home for $275,000. We're putting maybe $25,000 in to renovate. So it's not a major component like home building. It's just taking us a little bit longer to complete the renovation and to really go, to cash flow the home. So we're losing a little bit there, but in the grand scheme of things, and certainly anyone planning to enter an industry like this is a blip, right? It's transitory. At some point, we'll get through it. The longer term issue, of course, in building, and certainly in our case in build to rent, is going to be the labor. And that's why, I think, again, we're going to see exciting technologies like 3D printing, come along that, maybe not be completely viable today, but one day, maybe will be viable, and other types of innovations or technology, which will allow us to replace labor and make home building more efficient in an environment where we don't have the labor. So there's, we always respond to the challenges. That's what's so exciting about, business and capitalism. And I have no doubt that over time, those difficulties will lead to more innovation.
What they are leading to, though, is higher prices. And I know that for the home builders, the price of a newly built home, I think I did the report yesterday, was up close to 20% year over year. Existing home prices are up almost as much. But rents are up as well. We saw single family rents, I believe CoreLogic reported 7.8% year over year growth in single family rents. That is the highest growth that they've ever seen in that sector. So apartment rents are not growing quite as fast, but still a lot. And you're starting to hear these strange stories of bidding wars for single family rental homes. You go into an apartment, the rent is the rent. You can't really negotiate. You can negotiate concessions, but the rent is the rent. But when you see people, trying to outbid each other for a single family rental home, why are prices, and I ask all of this, why are they continuing to rise so quickly given affordability issues? And just how high do you think they can go before it all just breaks and the consumer just doesn't have it?
I guess I can start on that. I think one thing on the affordability side, we obviously keep a close eye on who are our customers, who's showing up to actually lease the homes and check in with us. And if you look at their income relative to the lease rates on the homes that they're leasing, it's as low as it's ever been, Diana, in the 10 years that we've been operating. So the people that are showing up to become our new customers this year versus this time last year and the 10 years before, have more income per dollar of lease that they're paying.
So we're seeing richer renters, is what you're saying.
You are, and I think it's also to, what Gary and Doug said, which is, the labor prices here and the cost of labor are going up. And if you think about who our customer base is, it's middle America, like Gary said in his introductory remarks. So you see that show back up, right? And you see the family that was earning $80,000 is now earning $100,000 collectively. And that wage growth is very real for that price point in America. And correspondingly, we have the lowest rent to income ratios that we've ever had in the last 10 years.
Yeah, I want to add one thing I just want to be clear on, because this has come up again, Diana. Institutional landlords like, Tricon or Amherst, it's a scapegoat if you think that institutional landlords are the one driving higher home prices. That's just not the case. That is misinformation. We're a drop in the bucket. I'll give you one example. In Halifax, a Canadian city, home prices are up year over year 40%, which is probably the highest in North America, probably higher than Austin, where Drew's sitting. There are no institutional landlords at all. There is no single family rental in Austin, right? There's a lot of factors which drive home prices. But what we end up seeing over time is that home prices and rents actually are very highly correlated. So home prices might move first, then rents catch up. I think we're in an environment right now where home prices are starting to stabilize. Trees don't grow to the sky. They are starting to stabilize. Rents are catching up, right? But we are obviously in an inflationary environment. We believe, as a good corporate citizen and landlord, what we do is when we have a resident or tenant in our home, we self-govern on renewals. So that's really important. We want to drive the lowest turnover model we can. And that means we do limit renewal increases as a way to, if people's wages are only going up by 4 to 5%, we obviously don't want to be passing on 10% renewal increases. So we're trying to take a long-term view in the way we think about our business and prioritize our residents.
And Doug, what about you? I realize you're in the luxury sector, so your buyers aren't exactly as dependent on, I guess they're dependent on mortgages still, but they have a lot more cash to burn. Do you believe that home prices are inflated right now, whether it's in the luxury sector or just in the rest of the market?
Well, they're certainly up significantly. As I said, I hadn't seen in my 31 years supply chain issues like this. I haven't seen pricing power in my 31 years as I've seen in the last 18 months. It is definitely settling down. It's still a very strong market. We still have demand that is outpacing supply, but the pricing power is moderating. It's still positive in most of our markets. We certainly aren't incentivizing at all. Some of our communities are still on allocation where we just open up a couple lots a month and we have a long waiting list. But in most areas, things have settled into what I'd call a good, strong market, but not a frothy market. And I think some of that is, a bit of sticker shock. When you're up 25, 30% in some markets, that house that was 500,000 18 months ago and may now be 750 or 800. There's certainly some pressure. The really interesting fact is that with so many people moving from California out and from the Northeast down south, you have people moving from very high cost of living places to more affordable areas. And so even as price is up, they're not feeling the sticker shock or the pressure as much as a local move up. And we still have many local move ups, but the migration trends have, significantly increased through COVID as people move to where they want to live versus where the job may have tethered them. And that in most cases means they're not feeling the pressure of affordability because where they choose to live tends to be less expensive than where the job had required it.
So do you think this urban exodus that we've been talking about for so long, and I'll put this to all of you because it definitely draws demand to single family rentals when people are moving into smaller cities, moving out to the suburbs, moving into those houses. New York seems to be doing really well right now. Not super well, but better. At least the real estate is coming back. Is the urban exodus, was it a myth? Was it a blip? Was it temporary? Is it long-term? I'd like everyone's opinion on the urban exodus. Well, Drew, start.
Yeah, I'll start. Yes. So, it definitely, for single-family rentals and in our markets, in our minds, it did pull forward some demand that would naturally show up. So if you think about our average head of household and our average customer is about 40 years old. So just now starting to sniff the oldest millennial population, and millennials are now starting to form households. It pulled up some of that demand, right, where people didn't necessarily want to live in the crowded multifamily tower if you were, a newly married couple. And so it did pull up some of that. But the trends of just how much demand is still yet to move into households in the southern southeast markets that we operate is really significant. So yes, there was some impact on the migration from both California as well as the Northeast. I mean, we saw that in a market like Phoenix, which has been really greatly impacted by the exodus from California. But more broadly, in our average market in the southern and southeast markets, there was some demand that was accelerated because of COVID. But it was really kind of the tip of the iceberg if you think about where household formation is and who our target customer is.
Yeah, I would say similar. I mean, I view the pandemic as just an acceleration of trends that were happening pre-pandemic. People were moving to the Sun Belt anyway. The way we think about it is 40% of the population roughly lives in the U.S. Sun Belt, but is getting 60, maybe 70% of the population growth going forward. So it's just a trend from north to south. That was happening anyway in search of lower taxes, more jobs, better weather. That trend's been happening. It just got accelerated. And now obviously with the pandemic, with work from home trends and this technology that we're using right now, I mean, if you basically can work anywhere, then why not live in the Sun Belt, right? Where it's more affordable and you've got, better weather and lower taxes. You might as well make that move. So that trend on the margin is going to continue these trends that were already there. But by no means does that mean that cities are dead. I mean, young people that are graduating from Cornell are going to go to New York, right? That's going to continue. But we're just seeing on the margin more and more people are moving to the Sun Belt and into the suburbs.
And Doug, what are you seeing in your urban development?
So, Gary's spot on. We repositioned our company south and west over the last decade, but we've also built 35 high-rise towers in New York City. We have a big presence with both condo and rental in cities, primarily New York. I wouldn't bet against New York. The first from March the 13th of 2020, when the country went into a state of emergency, until really a full year, until let's say March of 21, everybody left New York. It hadn't reopened, but in the last 9 months, we have extremely strong sales in our condo towers in Manhattan with no incentives. We're raising prices. Prices are higher than they were pre-pandemic. And, rents now in New York, residential rents in New York are at record levels. So the cities are fine. But yes, most people are choosing a southern or western lifestyle, better weather, lower cost of living, great jobs, great place to raise families. But I wouldn't bet against these cities. There's still a lot of people that are drawn to the cities, particularly New York, and they're going to be just fine.
I want to talk about the elephant in the room for a second on two different fronts with interest rates, one being mortgage rates and one being the cost of capital for those of you investing. On mortgage rates first, I believe I counted in 2020 13 record lows on the 30-year fix. That certainly helped a lot of folks buy a lot of homes. And it also helped to inflate home prices a bit, because when you have a lower mortgage rate, you have more purchasing power. We are now waiting, I believe, for the Fed next Wednesday to say something about tapering its bond buying. We have already seen the 30-year fix pop about 25 basis points in the last week, and it is on an upward trajectory, well over 3%. Doug, first of all, as a home buyer, since you're selling homes, do you have any concern that higher mortgage rates are going to cut into your business?
Sure.
I know you're luxury again, but any concern there?
Sure. I mean, you said it. It goes straight to monthly payment and affordability. At our price, 20% are all cash. Those that get a mortgage have about a 30% down, 70% mortgage. They're not maxing out. It's a discretionary buy. They're not focused as much on the monthly payment. But as you get down in price, down in the food chain, it has a much bigger impact. And when rates went to 2 3/4 in April of 20, the reason the for sale market took off in the early days of COVID was because renters realized they could own a home for the same monthly payment. And so they were trading the rental for home ownership. as those prices go up, those monthly payments go up because rates go up, the rental business probably is going to look even more attractive. But our business is solid. It's always been a bit more immune from rates, not completely, but absolutely I have a concern if mid threes were fine. I think if the 30-year gets over 4, then we got to be real careful.
Well, I hate to say that I bought my first house at 8% and I thought it was a steal, but that's just how old I am. Drew, do you think he's right that it's going to send more people to your business, to the rental market, because they won't be able to afford homes if higher rates, or perhaps just don't want to pay that higher rate?
There is definitely some of that, and there's this push-pull on the cost of ownership versus the cost of rental. As Gary mentioned early on, generally speaking, home prices or kind of the mortgage payment and the rent payments, like those two things are correlated and will eventually catch up to each other. But there's also a big segment of our customer base who can't get a mortgage. So there's some, no matter where mortgage pricing goes or where it is, however favorable it is or isn't, there's some people that out of necessity, leasing is their only option. And then there's also a significant portion of our customer base that out of desire, they're looking to lease a home versus own a home for the convenience, the ability to move around and not have to worry about capital expenditure. So there's definitely some of it. It definitely has an impact, and we keep an eye on what's the cost to own versus the cost to lease. But there's also other dynamics at play more broadly for single family rentals that make it a little bit more immune. Like you said on your other question, which is the overall valuation for single family rentals is obviously driven by the cost of debt financing, which with lower rates has obviously helped the equity returns from our own investments that we've made.
And that was what I was going to ask Gary to expound on, is higher interest rates in general cut into your business.
Yeah, they would obviously increase our cost of capital, certainly on the debt side, but look, on the margin, our business is just a tremendous hedge, right? So on the margin, if we do have higher mortgage rates, which we probably will a little bit higher, you're going to see more people want to rent. I'll give you an example. So we survey residents that are moving out, and during the pandemic, 25 to 30% have been moving out to buy a home. And pre-pandemic, that was in the high teens. So that, again, when Doug talks about much lower, mortgage rates, that obviously was an inducement to people to move out and buy. And I think as rates go back up, especially for our type of customer, we'll have more stay put. So I think net inflation in that sense and higher rates are a benefit for our business. Obviously, our cost of borrowing will move up a little bit, although we try to lock that in. But on the other hand, again, Drew talked about this. There's just so much capital coming into this sector. Because a lot of institutions now really face uncertainty in commercial real estate. How do they allocate capital? They've allocated, too much capital to the conventional food groups, malls, office buildings, hospitality. And so more and more capital is coming into what they call beds and sheds, and we're the beneficiary of that. And that trend's going to continue, and overall that's going to lower the cost of equity, I would say, in the business. So even in a rising rate environment, I still think we do well over time.
And were you hit at all by the eviction moratorium? I know it really seemed to hit more larger, low-income, multifamily buildings, but there were definitely a lot of single-family renters that just couldn't pay. Were either of your businesses hit by that hard, or not as much?
No, I viewed it more as so in our single-family rental business, we did not evict, for the non-payment of rent. So we did have some. I would say incremental bad debt, but, in a normal environment, our bad debt's typically 1% of revenue or lower. And we got up to about as high as 2.5%. And today we're about 1.5%. So it's come back down. So it was a cost, but I would view as an artificial cost of operating because we weren't evicting anybody. And I would also say in many cases, it wasn't an indication of people not being able to pay. It was more about being unwilling to pay. And we certainly saw in certain markets, people strategically deciding not to pay rent. But it was a small part of the cost of the business, and we're largely through that now.
Yeah, and I think it's also it showed the power of institutional rentals, which is very different than mom and pop single family rentals. I'm sure the story is similar with Gary. We forgave north of $20 million of lease payments. Obviously went through a checking to make sure that there was a real hardship and a need. And that's something that if you're an owner of 5 homes for your retirement plan, you can't do, right? If 3 homes can't pay, and having an institutional portfolio of thousands of homes enabled us to be very flexible and obviously work through the hardship cases, because there's a lot more of them, over the last 18 months than there were before. And similarly, right now, there's a lot of emergency rental assistance out there. I mean, the news stories are very accurate just in terms of how clogged up and jammed up and how difficult it is for those that actually need the help to get the help. We've been able to work with thousands of our customers to actually apply and work with them through that process. So I think that's the other thing. As you think about institutionalizing single family rentals, there's a huge advantage in terms of how patient, Gary and I can be with tens of thousands of homes versus owning just a couple of homes.
I want to get back to something that we started this conversation with, because before we got onto the public Zoom or public forum here, we were all chatting about this thesis out there that is that we don't have a housing shortage. I keep talking on air about this housing shortage that we have, that we're not building enough homes, that there aren't enough homes for sale, and that's why prices are so high. But there is a thesis out there by one well-known analyst who claims we are overbuilding homes right now. We are building too many homes because the demographics show that birth rates are dropping. We're going to have a smaller population. Everything is moving toward the need for fewer homes. Doug, are we building too many homes?
No, we are not. 6 million less homes were built in the last 10 years than each of the prior 5 decades. Going into COVID, we had huge pent-up demand that hadn't come out. The millennials were just becoming of age to start thinking about home ownership. I'm a boomer. I had my first house at 26, and my kids probably won't have their first homes until their mid-30s. But there's 75 million millennials who are now approaching or in their early 30s and approaching home ownership age. No, I think that there is a long runway ahead of us. The builders are disciplined through this cycle. I don't think we're overbuilding. And I think we're just fine. I don't think COVID drew out years of demand and got out ahead of the market. And I'm very comfortable with what I look at and what I see and where I see our business headed.
And so, Gary, you don't think that you've taken on all these houses, there's going to be too many houses, and when you want to sell some of them, you're not going to be able to?
No, it's just the opposite. I think that's crazy talk. I really do. I don't understand it at all. I mean, just to look at it another way, which Doug said, so we look at a metric called building intensity, which measures the amount of starts on let's say 1,000 population. And the building intensity today, this is more than 10 years after the Great Recession in the recovery, is still lower than 1991, which is one of the worst, housing downturns of all time. We're just not building enough homes. And you can see that clearly with home prices and clearly with rents. And now I think the pandemic's our version of a war, right? I mean, we don't necessarily know who we're fighting per se, but it's affecting all of us in profound ways. And a lot of people have woken up and said, I want to live in the suburbs. I want more space. I think if anything, there's going to be demand for more housing, not less housing. So I just don't see that. And we don't see it at all. I mean, we just see the opposite. I'll give you an example. So in any given week, we have 200 to 300 homes that are available for rent. We're getting 10,000 leasing inquiries a week, 10,000 for 200 to 300 homes available. So when I look at our businesses, we just don't have enough homes, not even close to enough homes. We don't have enough product for our customers. So I just don't see that. I would say, to those listening in, look, this is, business is cyclical, real estate's still cyclical, but don't believe all the doomsayers, right? There's always opportunity. And I don't see that.
So Drew, we have a no and we have a crazy talk.
Yeah, I'm somewhere in between those. As much as I love being a contrarian, I'm in the same boat. I mean, it's just that thesis could be true 40 years from now, but we got a lot of millennials to work through. And like Gary said, I mean, the facts of our business right now. So Gary was talking about how many inquiries. If you go and drill it down to how many qualified families we're turning away for every home we have available, it's 8 times. So for every one family we can move in, we declined 7. So I mean, it's a huge shortage right now. And the facts are where they are right now. And sure, you can play this out over a couple of decades, but it's going to take it's going to take a long time, several years of building a lot more homes than we're building right now to play the game of catch up. And it's most acute as you work your way down the price point, just in terms of where affordable housing is in America.
I know we're supposed to do at the end. I just want to remind folks that you can ask questions by putting them in the chat box, and we've already got a slew of them. So I'm not going to wait till the last 5 minutes because some of them are really good. So there's one question from Larry who says, Gary, you were talking earlier about 3D homes, about the new technology that we're looking at, different ways to build homes, ways to build them cheaper, faster, et cetera. He says, Gary, if you're alluding to 3D using concrete, don't you think this is a temporary fix, considering the environmental impact using concrete has regarding sustainability? And we know that concrete is one of the biggest carbon emitters, that is the creation of concrete. So that kind of moves us into the whole green area.
Look, it is today, but there's also concrete producers that have been able to, figure out how to, produce less carbon, right? And actually trap carbon. So there will be more technologies that are available that even make concrete itself a more sustainable product. But at the end of the day, the key thing there is, as Doug will tell you better than me, is just to make sure that we have a tight building envelope, right? And whether you can do that with concrete or with better insulation, with spray foam, the key thing in a home is to have a tight building envelope so you emit less energy, right? That's ultimately where we need to go. So there's definitely always pulls and, there's always pushes and pulls in the way we think about these. The same thing you can think about with electrical vehicles. Yes, the outsource is more environmentally efficient, but how do we produce that energy to begin with is less environmentally efficient. So there's, like I said, it ebbs and flows. But I think on the whole, the big issue, right, that we're talking about, that Doug's been talking about, is how are we actually going to produce the homes? There's a huge shortage of homes, right? And labor's becoming more and more difficult. Where are we going to find the labor to build these homes, right? People have to live somewhere. And ultimately, that becomes the real sustainable issue for me. If people don't have a place to live, right, and you have 20% home price appreciation or rent growth, that's not good. That's not sustainable. And ultimately, we need to use these technologies in order to be able to increase supply and help the labor shortage.
Doug, one of your competitors announced this week, Lennar, that they were getting in the business of 3D printing homes, that they would be the first big builder 3D printed home community in Texas. Is that something you want to get into?
We're studying it. I was happy to see the announcement. I think it's a 100-home community in, I can't recall which Texas market, coming online either next year or the year after. We have our eye on it. It hasn't made sense for us yet, particularly, our homes are a little bit bigger. We serve a different segment of the market. We do a bit more customization. And what they're doing in this one community are much smaller homes that appear that they will repeat themselves down the road to make it efficient. But that's one option that's out there. The modular home that's being built in the factory and shipped is something that I embrace. Very little has changed in 30 years in how we build houses. You drive to a Toll Brothers site and there's all you see is pickup trucks everywhere, framers and plumbers and HVAC and drywall hangers, and it's just 35 different subcontractor trade groups are involved in building a home, and it just hasn't changed, and it needs to. When lumber got very high last year, we built with light gauge steel studs in a community in North Carolina, exactly when steel went up and lumber came back down. But the entire industry is hoping for opportunities to be more efficient, to have less of an impact on the environment. But no one has cracked that nut yet on a production level. You do hear about the modular homes that tend to be custom or one-off, but right now it's significantly more expensive than the old-fashioned way of 35 trades on the job site.
And energy efficiency is becoming more important to the consumer, as we know. But millennials want smart homes, they want all the technology, but they also want the technology to help them save money on all their bills, and they also want to feel that they are in a green home. And right. This comes with your renovations to your single family rentals as well. To all of you, I would say, how important is it to you to reduce the carbon footprint of the homes that you're renting and or building, because real estate is a huge emitter of greenhouse gases?
Yeah, I would say, look, it's very important, and just piggybacking on what Doug said, there's a lot of improvements that this part of our real estate ecosystem is ripe for. And one of the things that we're taking a step back on is really getting the product right. So when we go and build a home for a build to rent community, we're going to own that home, Diana, for 30 years, not 30 weeks like home builders, would potentially. So we have the ability to really take a long-term view, and we can go spend more and spend in places that won't necessarily make sense, upfront for home builders. And part of that is the environmental aspect. Part of that is just the product that what today's consumers want to see. And so we're really focusing a lot on what is the product that consumers want and need, and where should we take the industry. And I think we have a very unique angle that we can own this home for multiple decades and plan on owning it for multiple decades, which gives us, in our minds, the ability to spend more upfront that might otherwise not fit into the business model.
There's a question from Raj Paul in Seattle, who says that in Seattle, builders are building less homes and tons of apartments. Is that energy driven? Doug, you want to take that?
No, I don't think so. It's very, very hard to get land entitlements in the Seattle market. I think if you have infill, brownfield, redevelopment opportunities that can go with higher density, they naturally become apartments, and that's what I think you're seeing more of. There's some, whether it be Bellevue or Kirkland or some of the inner ring, cool, more urban areas to live, you're seeing higher density. The home builders struggle in Seattle because we can't get the approvals to build detached single family homes, but it's not driven by energy. It's just driven by a very difficult entitlement process, I think, is the answer there.
The one thing I just add, you got to look at it holistically, right? Because every apartment building that gets constructed is a carbon emitter, right? Unless it's net zero. They're being built with concrete, steel. They're carbon emitters. But if you can congregate people in a tight area, then you have less sprawl and you use less energy in that process. So again, you have to look at it holistically. You can't just look at one building and say this is efficient, but then how did you get there? I would tell you in our single family rental, everything Drew said is correct. We're trying to do our best to think about climate change and to produce, a more energy efficient home. But if you actually if you were to poll our residents, it wouldn't be the top 5, I think, considerations of our residents. Number one consideration for them is always going to be affordability and location. Energy efficiency, even though we're trying to add those features through smart home technology, would not be, top 3 or 5.
Yeah, I think Gary's correct. We are pushing hard with energy efficient options in our home, whether it be high efficiency furnaces or solar power through roof panels, recycled water for your irrigation systems outside. And many people love it and want it, but there are still many who say, instead of giving me $20,000 of energy efficient goodies, can I upgrade the marble counter in my kitchen and have a more beautiful master suite, the things I can touch and show off?
It's not what we want to hear.
I know, I agree completely. But there is a mentality that, not everybody, everybody wants to talk about it, but when it comes to their pocketbook, it doesn't always end up that way. But we are absolutely pushing it. Most progress is being made through California. And with a lot of issues like this, California will lead the country. Right now, solar is mandated in California on all homes. And it's great. We embrace it. We're going to spread it around the country. It is adding costs. That all I'm trying to suggest is the client doesn't always recognize the value of the added expense.
Interesting. Not what we want to hear when we have one of the biggest climate summits starting next week, where real estate is actually a very big part of it. But I guess it is what it is. I think I have time for one more question from someone, and I think this goes on to home buying as well as renting. Louise says, do you think the industry needs to do anything to make more opportunities for affordable homeowners for non-white buyers, given continuing discrimination by many mortgage lenders and regrettably also realtors, and I would also add rental agents to that?
Yeah, I hit a little bit in my opening or one of my earlier comments, which is this idea of the fact that you need a mortgage to live in a neighborhood as a prerequisite is something that I think needs to be challenged. Yes, there's this home buying dream here in America, but institutionally to raise the capital that Gary and I have raised and others, right? Fair housing is through and through. There's not discriminatory practices anywhere in our organizations. And in fact, kind of we actually work the other way versus those who can't, work their way through the mortgage system for whatever reason. So, I think it's something that institutional single family rental is really a big advocate of that statement.
And I would say, the most important thing is as you're conducting your own corporate culture and building your organization, we want to have the most diverse organization we can so we understand those issues and we understand, what our residents or consumers want. So that's where we start by prioritizing our own people so we can serve our residents. And then we try to help wherever we can with a lot of different programs. But I would say we don't have time to talk about it, but it's a touchy subject because I think a lot of the NIMBYism, right, that comes from this topic that really kind of you can pull from this question, the NIMBYism is what's really preventing more supply, right? And that comes back to all the, the concerns about home prices and inflating rents come from the fact that we're just not able to add the supply where we want in so many parts of the country, right? It's not just fair housing. Fair housing is an issue, certainly, but then there's also the fact that we're just not producing enough supply because so many neighborhoods or municipalities are trying to protect their own turf.
And Doug, do you want to have the last word on this?
No, I think that they both covered it really well.
Okay, great. Well, we don't have enough time for another question. So Alan, I'm just going to thank all the panelists, Gary, Drew, Doug. It's been great. And Alan, thanks again for the opportunity.
Well, thank you. What a wonderful discussion. Dan, I want to thank you for being such a great moderator and weaving important sustainability topics kind of in the built environment, especially before you head to Glasgow for the Global Climate Summit coming up tomorrow. Doug, Gary, Drew, thanks for sharing your candid perspectives on all the relevant topics that are affecting residential real estate during a pretty unusual time, as everyone has alluded to. We truly appreciate your participation. I am sure our audience, like me, thoroughly enjoyed the outstanding and informative discussion. Lastly, it bears repeating, we appreciate the generous support of our sponsors for this conference and CREC's mission, and in particular, Bruce Backen for sponsoring today's event. We look forward to seeing everyone, hopefully for the remaining two events. The next one's going to be next Tuesday on November 2nd at 11 a.m. Eastern. We have an amazing group of chief executives from leading prop tech companies, so that kind of dovetails very nicely with a lot of discussions we had today on technology that came up. And they're going to discuss technology's rapidly changing transformation of the built environment. And it's going to be moderated by Brad Grew, the co-founder of Fifth Wall, the largest venture capital firm focused on prop tech, late-stage prop tech. More information about the remaining webinars can be found on the CREC website. It's free to become a member of CREC. I hope you'll join us, and thanks again for today's discussion.